Hello, everyone. Welcome to the online session of Global CIO Symposium, Global Investment in the Restructuring World, co-hosted by VS Partners and Financial Times and the Financial Times Chinese.com. And I am CIO of VS Partners. And today we are very glad and honored to have our distinguished guest, William from UK. This is a very early time in his time zone to join us. So William is the CIO of Bluebox, and he used to be the portfolio manager at Blackrock, running the global developed market strategy and being top ranked in the industry. And William, welcome to the symposium.
Pleasure. Thank you for having me.
First of all, on behalf of our audiences, we thank you very much for having this early session with us and looking forward to a wonderful discussion of your approach to global technology investment to the global audience of Financial Times, particularly in Asia. I think some of your ideas will be very telling for Asian investors to think about long-term technology investment. So, many say, or perceive rather, technology investment to buy things that are disruptive or new, which often is also emotionally inspiring and eyeball-catching. But your approach has delivered a superior return by not investing in disruptors, and rather you invest in those enablers that are not new companies on the horizon, and in your own words, sometimes they can be very boring. Can you elaborate to the audience why the disruptors often do not create or even sometimes destroy value from a public investor standpoint, and why the boring companies are indeed more attractive investment target?
Yes, so we've got to think about what a disruptor is. A disruptor generally isn't a technology company. It's not selling technology. It's selling something else, and it's found a new way to sell that product using technology, disrupting the existing business models. So disruptors basically are users of technology in other sectors, and they're turning those industries upside down. The problem is disruptors, almost without exception, are not companies that make money. Disruptors are companies that spend money. They're companies that spend an awful lot of money on technology to grow very fast and make life difficult for everyone else around them. And another problem is disruptors basically disrupt once, and then generally someone else comes along and disrupts them with an even better business model. So as an investor, they're not really that interesting because first of all, they're not very profitable, if at all, and then they die. So why would you bother with them from an investment point of view? They're very exciting. They're changing the world. I'm very glad they exist because they're making our lives better. But as an investor, you're much better off looking, where is this money being spent? And it's being spent with what we would describe as the enablers. So the technology companies that are providing that vital technology to the disruptors to do what they do. And because that's where the money's being spent, the enablers are companies that make the profit. Enablers can be phenomenally profitable. And because they enable one disruption after another, which is generally the pattern. They don't just enable one disruption, they enable disruption after disruption after disruption in lots of different end markets. Those profits, if you pick the right ones, can outgrow the market year after year after year. So enablers are attractive. They're very profitable companies and their profits outgrow the market. Disruptors don't make money and then they die. But the problem is everybody spends all their time on the first lot, the disruptors, because they're much more exciting.
Yeah, I think, let me take a step back. Actually, perhaps it's helpful to define what you think as a technology investment. And there are a lot of disruptors from the internet commerce space that sometimes people categorize them also as tech companies. And particularly this year in China, tech companies or internet commerce companies has experienced very stiff correction. So can you tell our audience about, in your approach, how do you define what is a true technology investment and what you see is technology, what you see is not?
Yeah, I think it's incredibly simple. if a company, what does a company sell? What is the product? If it sells technology, it's a technology company. If it sells the bicycle delivery of food, but powered by technology, that's a food delivery company. If it delivers ride sharing, but it uses a lot of tech to do it better than everyone else, that's a ride sharing company. It's not a technology company. When you look at it that way, it's very, very simple. And they look like two totally different types of business when you analyze them. And think about Google or Baidu, they're not actually technology companies, they're advertising companies. That's what they're selling. They're selling advertising. They're using a lot of technology to do it. And bits of those businesses are tech. So if they have a public cloud business like Google Cloud, that's a technology company that's selling technology, renting it basically to other businesses. But in the most part, those two companies, what they're doing is selling advertising. So they're not tech companies, they're media companies.
Right, so you invest in enablers, and you just mentioned some of those other business models. They sell some other services, but they build on the technologies that enable them. So what are the innovations in business models in the real economy that you see are enabled by the technologies that produce opportunities for your portfolio in the next, let's say, 5 to 10 years?
Well, I think you have to explain why technology has been doing so well in the last 12 years or so. So technology, the broad technology indices have outperformed the broad market pretty much every quarter since 2008. And that has to be explained. That isn't normal. We all now assume it's normal because it's been going on for 12, 13 years, but it's not normal. It certainly wasn't happening before that, and we don't know what's going to happen next. You have to explain what's going on in technology. And actually, when you look at what's going on, it's actually pretty obvious. The reason technology has been doing so well during this period is because it's the only bit of the market, well, it's the bit of the market that is responsible for all the growth of profits. If you basically put a chart together of the operating profits of the tech sector and the whole of the rest of the US market, the whole of the rest of the US market has seen no growth in profits since the end of 2009, almost none at all. It's pretty much exactly flat. And the tech sector in the US has grown its profits by about 12% a year over that time. And that explains why technology has outperformed. So that's the immediate reason. But what is it that's driving that? Because that has to be explained. Now, again, that shouldn't be the case. You shouldn't have one sector that's responsible for all the growth in the market for such a long period of time. And the reason this is happening in our view is a change in the way that technology operates that started in around 2005. And it's basically removing human beings from the loop. The fundamental change in technology in the last 15 years is that human beings now just set these systems up and we're no longer the input and output device for the system. We've taken ourselves out of the loop, and that basically enables, it increases the speed of the system so much, millions of times faster, because the human beings were by far the slowest bit of that system. And if your processes can run millions of times faster, then hundreds of times more applications become viable. Everything that's exciting today in tech and using tech in every other sector, pretty much every single one depends upon removing the human beings from the loop, directly connecting systems to the real world. So any technology company which is directly involved in that is basically in a very, very strong position because it's on the right side of that massive trend that will take decades to work its way through. So a specific example would be analog companies. Analog companies are pretty boring. In little analog chips, they only sell for a few cents. They don't change a lot. But if you're thinking about removing human beings from the loop, so suddenly a digital computer has to understand the analog world that we live in, you have to have an analog chip of some sort between that digital computer and that analog world. And you've probably got hundreds or thousands of them. And that's why the analog companies have gone from being $1 or $2 billion companies in the late 90s to now being $50, $70 billion companies. Very quietly. No one really is interested in them because they're very boring, but just look at the increase in value for this really boring group of companies. And they are the perfect example because they are phenomenally profitable. They used to be phenomenally profitable small companies. Now they're phenomenally profitable, very, very big companies. And it's because they're absolutely at the heart of everything that's going on in technology and the deployment of technology in other sectors.
Well, you just perfectly lead into my next question, actually. But I'm going to dig a little bit deeper. You mentioned a very important phenomenon over the last decade that any investor would have done quite well simply perhaps by just owning a NASDAQ ETF, and which is by and large driven by a handful of large cap tech companies. It's very difficult to beat the benchmark in such environment if one doesn't own those handful names. And even, but if everybody owns all those names, everybody's portfolio would look the same. And how do you, what is a way to beat the benchmark, which had done very well and dominated by large cap tech, without owning those fan names or Meta? No. For example, the most difficult benchmark, MSCI Global Tech Total Return. And how do you do that? Is there a way? Is it possible?
It is possible because we've done it, and I don't particularly like the FANGs or the mega caps. So we're not particularly interested in the mega caps, and we're not at all interested in the FANGs, really. So I have owned a bit of Amazon in the last few years, but not very much, and we don't own any now. And we owned a tiny bit of Netflix, or a little bit of Netflix when we first launched the fund, but again, only for about 4 months. So we've basically been FANG-free since the launch of the fund. We are substantially underweight the mega caps in general. And to me, a mega cap is a stock with a market cap of more than 1% of the S&P 500. It's a moving target being a mega cap, and that's about a $350 billion market cap. So I would regard anything with a market cap above that as being a mega cap. And that's a group of companies we're not really very interested in, because those are essentially the winners of the last round of disruption. And the history of the tech sector is, again and again, that those companies collectively will be the losers of the next round of disruption. They got the share to lose. They got it right. And it's very unusual for the leaders of the industry in one round to win the next one, 5, 10 years later. So to me, they're not a particularly attractive group of companies. In order to outperform, it's not good enough for them to just grow. So if one of these mega caps grows fast, reasonably fast, it can outperform the broad equity market, but it needs to do more than that, in my experience, to outperform technology. It has to change its business model for the better to materially outperform. And these are already the best business models in the world. So how much better they can get? And you think about Apple. Everybody thinks that Apple is a huge investment success, which it is. It's done pretty well. It's beaten broad global markets since its peak in 2012. It's ahead. Substantially ahead. It's only just ahead of the tech index since then, because essentially it's exactly the same company as it was in 2012, but bigger. It hasn't actually launched any interesting new hardware products since then. AirPods, which replace these things I'm wearing, and tags, and that's about it. So there's nothing really very new about Apple. It's just endless iterations of what it's done very well already. And that's not enough to give substantial outperformance. I think since the peak in 2012 to now, it's about 15% outperformance over that 9-year period. So you can beat the mega caps, you can beat the FANGs by finding companies that are doing something really useful, but going down the market cap scale, but not very far. So, we tend to focus on companies with a market cap of $10 to $100 billion companies. Those are still absolutely enormous businesses, and they got all the liquidity and all the information you could possibly want as an investor. But a $10 billion company, if it gets it right, it can turn into a mega cap. And that's, under our definition, an increase in value of 35 times or more. And in tech, that can happen surprisingly fast. I mean, it's not going to happen overnight, but it can happen in a fair few years. So you can get huge changes in valuation in this large cap space, which you can't really achieve in the mega caps. It's much harder for them to dramatically outperform. So we proved you can do it. We don't like mega caps particularly, and we don't own any FANGs, and we've beaten the toughest version, the broadest global benchmark, and almost all our peers as well. So you can make it work.
So you're not interested in the winners of the last round of a disruption, and you are looking at the potential winners of the next round of the disruption. There's no winners forever.
So I'm actually less interested in the winners of the next round as well. What I'm interested in is the people that power that next round. And they're probably the same people who powered the round before and the round before and the round before. So I don't need to pick the next Facebook. I'm not interested in doing that. I want to pick the companies that provide the ability for the next Facebook to do whatever it is that it does that beats Facebook with. And that's a more reliable long-term investment approach, in my experience. Sorry.
I think you really read my mind of my next question, which is there are a lot of meme stocks, electric cars, AI-related specs that became a phenomenon over the last 12 to 24 months. And now the buzzword perhaps is the Metaverse. Everybody is talking about Metaverse. Do you regard any of these trendy buzzword as the next round of a disruption or not? And lately, there's a lot of discussion going about it, and I think the capital market has, to some extent, reacted to that. How do you assess these new phenomena, and how do you express your view in investing either on the opportunity side or on the risk side of these new buzzwords?
Yes, well, the Metaverse isn't that new because it was Snow Crash in 1992, as far as I'm aware, is the first place to use it, along with quite a few other ideas. Extraordinary book, really is. But to be honest, I'm not really interested, and I don't feel I need to pick that, and I'm not very good at doing it. So, I will say to you at the moment, Metaverse seems a bit strange unless you've got amazingly good contact lenses and you can see it the whole time. What's it going to achieve? And I probably haven't got it, but actually, I don't need to. I didn't really believe in iPhones. I thought, why would Apple want to make a phone? That seems a really daft idea. I love my iPhone. It's amazing. It's changing the world. But you don't need to get those big calls right, I'm afraid. It's much more impressive if you can brag about getting them right. And if you are very, very lucky and you get exactly the right company, you can see vast increase in value. But I'm afraid that 9 out of 10 of your picks are probably not going to work. But if you pick the companies that are powering all of that disruption, which are exactly the same as the one that was powering the round before and the round before and the round before, then this new disruption basically creates new demand for the products your companies are selling, but they're essentially selling the same stuff. So I'm afraid for a tech manager, I'm pretty boring because I'm not really interested in what's coming next because my companies are already benefiting from it. Whatever the hot technology story 2022 is that none of us have heard about yet, there's a company in Beijing or in San Francisco that is making it happen today that we haven't yet heard about. But in order to make it happen, they have to connect their systems to the real world. They have to remove human beings from the loop, which means they're buying stuff from my companies now, and I haven't even heard about them. And so the business comes to my approach. I don't have to go out and get it, which means I'm really not particularly popular in tech dinners or anything like that because people ask me, what's coming next? I have absolutely no idea. And I don't really care, to be honest. Because I know my companies, whatever it is, will be the ones that make the money out of it. So it's boring, but it works.
Right. So I think one of the key takeaway for the audience of this streaming is that Metaverse is not new, right? And a lot of people mistakenly think Metaverse is very new and all of a sudden become fashion this year. But going back to your point of you're much less interested in the upside potential of the mega caps, but rather focus on the big cap, the large caps between 10 to $100 billion. You mentioned analog as one of the key technological enabler. What are the other verticals or silos in those 10 to 100 billion range that also interest you, that you think enabling new business models, new demand, that you are actually paying attention?
So one of them is an adjacent area, which is semiconductor production equipment, so capital equipment for making chips. So we've all heard that software is eating the world, and what was meant by that is eating the hardware business. Hardware is having its value reduced from one side by software, but on the other side by semiconductors. So semiconductors and software are eating the hardware industry. They're extracting the value and just leaving the guys as box makers. But the semiconductor industry, in turn, is being eaten by the semiconductor production equipment, the capital equipment market, because actually that's where the intellectual property for manufacturing semiconductors, chips now lies. And those companies are just steadily increasing in value. And people perceive them as extremely cyclical. They are cyclical. They're not as cyclical as people think they are because they remember the 90s when they were sort of suicidally cyclical. They're much better run, much more stable businesses now, but they are very much growth cyclical. And people misunderstand what growth is. People focus on top line revenue growth. Revenue growth is almost totally irrelevant once you're a mature company, a bigger company. Okay, it's important when you're a startup, but in the end, what you have to have is profits. So what you should be looking for in a growth company is growth of profits, which is what everybody looks at in every other sector. But in this sector, people focus on top line growth, and actually, you can't live off that. You need profits to live off. So if you look at the semiconductor equipment companies, the top line growth is good. It's probably high single digits, low double digits, but the bottom line growth is very consistently in the high teens or better. And that's what gives you long-term outperformance. So that's one of our favorite areas. So analog chips, semiconductor equipment, those are two good areas. Whereas the other bit that's eating the world, software, the problem with that is that most of the really exciting companies there, which create lots of positive free cash flow, they generate huge value for their customers. They're growing very fast. They must be great, generating value for customers. But the problem is the value that they're creating as businesses is not in general going to the shareholders. It's going to the employees through stock option grants for many of these companies, if they're based anywhere near San Francisco, that is. So the semiconductor companies are eating the world, and that actually the value belongs to the shareholders. The software companies are eating the world, but the value belongs to the engineers, because the engineers are the scarce resource. They're getting paid, and brilliant people doing extraordinary things. They extract the value, and we tech investors have been trained to believe that those stock options are costless. That's what we've been trained to believe, and that's absolutely ludicrous if that's what you believe. But that's what the world does. So the value is being extracted from software companies, and it's going to the engineers who are the scarce resource. We investors are not the scarce resource. Don't think that you as an investor are the scarce resource. There's not. There's millions of you and trillions of dollars trying to get to these companies. There are other scarce resources, there's software engineers, battery power, and at the moment chips, and that's where the value goes, where the scarce valuable resource. I can't remember what the question was. Was that an answer to it? I hope it was.
No, when you mention semiconductors, I think it resonates very well with the Chinese audience, because as you're aware, in the midst of U.S.-China tech rivalry heightened over the last couple of years, particularly semiconductor and the IC industry also becomes a national focus on the industrial policy side, and people generally are aware of the importance of it, more so than never. But this is also a sector that's capex heavy, and it's almost entering into a arms race, if you will, of a heavy capital intensity at the highest level. So particularly, can you go a little bit more about the semiconductor, of what nature of the opportunities in the vast global value chain that you identify as attractive profit growth generator, instead of too capital intense, and that might impact the shareholder return eventually?
Yeah, so there are various big segments of the semiconductor industry. We talked about analog, we talked about the equipment companies, and then there's the digital side, which is both IDMs, companies that make their own chips, and increasingly foundry. And if they don't make their own chips, then you'll have fabless companies, the chip design companies. And you also have companies that sell blocks of IP, so ARM and so on. But if you're thinking about the people who actually make chips, essentially you've got memory, logic, and analog. The analog market uses effectively very old-fashioned technology, stuff that would have been cutting edge 20 years ago or whatever. So that's not particularly capital intensive. That's why they got such high returns, such high profitability, because it's the design that's important still, rather than the production process in general. The memory companies are at the other extreme. So if you're a memory company, you cannot stop investing. However bad the economy is, you've got to keep building new fabs, because if you don't have cutting edge production, on the latest line width at scale, and you've got your ramp up, so you're not losing too much stuff to errors and stuff, then if you're not in that position, then you are way behind the cost curve and the product capability. So you will not get a good price for your product. So memory companies just need to keep investing at leading edge and leading edge and leading edge and leading edge, and it's incredibly expensive. And a new leading edge fab now is $20 billion potentially. That's a vast amount of money. It's going to take you 3 years to build it if you're starting from scratch. So that's very, very capital intensive, and it's not a great industry to be in, to be honest. I mean, if you're Samsung, you can make good money out of it. If you're anybody else, it's almost impossible. So you're just running to catch up the whole time. And people therefore look at a company like Lam Research, which is a capital equipment company, and say, this business is overweight. It's overexposed to the memory market. It sells more equipment to memory companies as a portion of its business than anybody else. And memory is not a great market. People recognize that. Therefore, Lam Research must be a poor business as well. And that's just, why is the memory market bad? Because of its capital intensity. Well, what does Lam do? It sells capital equipment. That means Lam's the most interesting company in the world, because it's the one that's basically the problem for its customers, because it extracts so much value from those businesses. Logic is very fragmented. There's lots of different elements of it. If you're not the leader of foundry, again, TSMC is clearly the global leader in foundry, making chips for other people. That's going to be the company that makes all the money, and everybody else does well to break even. If you look at global foundry, it's doing well to break even. Other areas of digital, you get some very targeted companies that do something extremely well. So NVIDIA, for example, no one can really compare with it. It makes extraordinarily good returns. It's not capital intensive. It uses other people's fabs and so on. So Qualcomm has got a niche in that it's got this chunk of the market. It provides a vital technology, which, 20 years later is still vital, extraordinary. And so it has a grip on the value chain. But there are other companies which really are, they're not also runs, but they're in the pack, and it's much harder for those companies to make lots of money because logic is still quite capital intensive, and if you're not the leader in your space, it's very difficult. Sometimes you can overturn that. Intel has been the leader in its space in microprocessors since forever, but AMD changed its business model dramatically, got rid of its fabs, so it outsources all its production. Some absolutely brilliant leadership by its CEO, Lisa Su, and that company has suddenly got to the point where it's using TSMC's leadership in production because TSMC has overtaken Intel in production capabilities, and AMD is using that very effectively to take share from the company that used to just basically squash it at will. And now that enormous installed base that Intel has, which used to be its vast advantage, is now a disadvantage. It's a dead weight around its neck because it's non-leading edge, but it still needs to be maintained, upgraded, and so on. And yet it has to rent the leading edge stuff from TSMC. So that's what's going to happen. So companies that are in a strong position in logic can lose it at times. So those are sort of the prime areas within semis as I see them anyway.
Right, in that prime areas, you mentioned something, the company perhaps is more valuable if the technology they possess is more vital. But there is another risk we have to look at. The more vital your technology is that company more susceptible to geopolitical risk? Because I have to ask this question. And do you take that into consideration when you manage the risk of your portfolio? And by the way, we have 5 minutes, so I have one last question after this one. Please go.
Okay, so we do, and very much, and particularly in the last 3 years or so, it's been absolutely vital. So, and semiconductor equipment has always been an interesting space for me because it's at the center of the industry, the technology industry, but it's also at the center of geopolitics as well in the last few years, because it is a vital bottleneck where the US still, or the Western companies, the US, Netherlands, and Japan basically still dominate the leading edge of that. So there isn't really much in the way of competitive domestic industry at the leading edge within semiconductor production equipment. And that's a sort of key gap in the Chinese lineup. But everybody's building fabs everywhere in the world as fast as they possibly can, subsidizing to be built on their own territory. And that means a lot of money is going into subsidizing new capacity and therefore duplicating capacity as well. And that's not probably great for the efficiency of the industry. And there's a lot of public money in various governments are spending. But from the point of view of the companies selling the equipment, that's amazing. I mean, it's a fantastic position to be in because basically governments are paying people to buy their stuff off them all around the world and duplicate that capacity. So it is a very interesting time, but it does look as though there's a pretty distinct bifurcation between China and what one might call the Western companies. But the key overlap still is the semiconductor equipment at the leading edge, which is still a distinguishing or a competitive advantage for the US and its allies, the Netherlands and Japan.
Right. So the ending question is that you brand yourself as a missionary to show the world that by investing in the foundational enablers, quote unquote, boring companies that last long rather than the eyeball-catching new disruptors, you can outperform index and tops the industry. So what are the last words you want to leave to the audiences? What are the most important enabling technology for the next decade if we look into that far?
Oh dear. I still think it's probably still semiconductor equipment, until quantum and optical computing come in, silicon and its related materials are still at the center of every single piece of technology. So I think the single most important bit of the industry is still the semiconductor capital equipment section.
Okay, thank you so much, William, again, for being so early in UK in the morning to talk to the Chinese audience on your fascinating ideas about, investing a pretty much a fan-free portfolio, but still beat the world. And congratulations to that achievement. And one day we hope to meet you in China. And in our offline session in about an hour, we do have a semiconductor private equity investment expert in our closed door session, and I would love to bring these greatest minds of tech investment in the world together on the VSP platform. And thank you again. Talk to you soon. Have a good day.
Thank you very much for your time. Thank you.
Goodbye.